Hello, how are you now? Thank you for joining us. My name is James Whelan, our investment manager for the VFS Group Global Macro Fund. Welcome to the March 2021 summary of markets. Yes, don't overdo it too much. I do apologise for the mess behind me. It's a tutu. My daughter's got a big dance thing coming up. She's got things. Everything's all laid up. So I didn't want to get in the way, but I did have a few minutes spare. Now, this is how busy I am because it's midway through April and I'm only just recording my March update now. I do apologise for that. I promise that I will be quicker on these things in future, so please forgive me. I'll endeavour to do much better in the future. Now, let's cut to what we need to cut to. That's me. Hello. Good. Everything here is general in nature, as you know, as you love, and that's the way that it goes. If I happen to say anything that sounds like personal advice, trust me, it is not. There is nothing that is taken into account any personal considerations with regards to what's ahead. All general advice in nature. If you've got any questions, let me know or talk to my lawyer. Now, the next good thing. So April historically is the best month, and we've already seen that. It's easy to say this. We're already halfway through, but I was saying this at the beginning of April that April is traditionally the best month in the S&P 500. The last 70 years has shown that. 74% of the time, the S&P 500, which is the key US benchmark, is up. It's already up 4%. On average, it's up 1.7% of that 70-year period. We're way overs at the moment. It's absolutely busted out of the box. Be invested, stay invested, which is what I've been saying. No arguments there. We're going to start now looking forward to May. Sell in May and go away. I'm probably going to be doing that. Look towards this. The selling needs to start coming in now, soon, whatever. But the way that the market's going, it's brave of me to charge in there. Up for the month, 0.39%. I'm still sort of making amends for things that happened in February. I don't want to talk about that too much, but a couple of clangers in February. One big clanger in February I don't want to talk about. But look, had it up above the 3% mark and then it tucked down. It is already well and truly up above the 5% mark now that we speak, just in the 2 weeks that we've been doing this in April. So it's fantastic. For the quarter, to about 2.5%. Pretty happy. I'm looking at maybe a 10%. This isn't an annualized return. Don't get at me about it. I'm looking at an annualized, so 2021 being about a 10% year, provided I keep on ticking the way through, and the positions of strength that we're in right now to make the moves that we need to make to make everything work. So be aware, and that's how I'm going to be running that through. Global markets, all the oil countries, was it up 2.2%? That seems a bit strange. No, don't worry about that. About the oil countries, that's a mistake. But like I said, the S&P 500 is up about 4%. Be aware of that. Now, where did the returns come from? Over on the right side of your screen, S&P, the high beta, the right side of the screen up here. You got the high beta, the pure value, enhanced value, the high div. So that basically the high div is the value stuff. So we've seen the value has really gone out of the box. The S&P 500 for the quarter up 6.2%. And the massive outperformance in the value stuff. So really helped us out, the value things that we had involved there. Should have been a bigger allocation to it. Absolutely should have been a bigger allocation to it. So that's something that I'm just going to sort of regret that it wasn't super loaded into on that one. So what's next? Retail is here to stay. That's it. Retail is here. Retail trading, this is amazing, now accounts, so this is one of the big things I'm looking at. Retail trading now accounts for almost as much volume as mutual fund and hedge funds combined. People are saying, oh, you're just retail guys at home in the Robinhood account, that just whatever. No, that trading is now serious weight. Look at how much it is. So the high frequency is a big volume of trades, it's okay. But these guys are in and out of markets, these retail guys, they're in and out, and the volumes that they're in is bigger than hedge funds and bigger than mutual funds put together. So don't be on the wrong side of that trade. Good on them, I'm saying. It's fantastic. I'm not against it. The market should be accessible and accessed by everyone and all the time. But don't be on the wrong side of that trade. Don't want to get hit by the bus. So those speculative stocks, thinking of shorting, don't do it. Don't even think about it. So that's what that is. So that's just an interesting factoid for you there on that. Next one. Now, here's a really interesting stat that inflows to stocks of the last 5 months have been greater. This came out of the Bank of America fund the Flow Show, which is a research report of theirs that they do every month. 5 months, the last 5 months of inflows into the US global equity funds, is bigger than the previous 12 years. So over a decade worth of flows has been significantly beaten dollar for dollar in the last quarter and a bit. That's a real thing. That's a real thing. Be aware of that. Pay attention to it. Over on the right side, have we run too hot too quickly? This is a really interesting stat that's here. That at the beginning of the month, at the beginning of the year, analysts, the really top guys, the amazing guys, are all asked to give their ideas and their views on where they think that the US market is going to close. The average of all of the smartest guys in the room was about 4,099. We hit that last week. So that's only the beginning of April as well. So we've still got another few months. So expect analysts to either increase their targets or expect the market to just come back and just meet the mean. It needs to. Like I said, 1.7% for April. We're already 4%. May is not going to be a particularly good month. May is seasonally not a particularly good month. There will probably be a little bit of profit taking. Maybe that needs to happen now. So I'm just going to move some stops up, I think, on my positions. Take a bit of profit on those ones. Next, fund manager survey. I always look at the fund manager survey. Bottom line, the only reason to be bearish is there's no reason to be bearish. That's pretty much the same as what they said the month before. Biggest tail risk is for March. Higher than expected inflation is now for the first time in a very long time not a COVID-related situation. It's now rotated that whole way around. People are now really concerned that inflation is going to be out of the box. I am also concerned that inflation is out of the box. If inflation does jump out of the box like a jack in the box, you can have a real situation on your hands, and you have to invest accordingly. Be aware. Cash levels, top right, up to 4% from 3.8% the month before. That's fine. It's still not a lot of cash that's kept on the sidelines. People are still very invested. You have to be. It means there's not a lot of cash that's sort of around to save the market if it does drop down. But don't think bearishly, think bullishly. But they're invested in the market. You have to be invested. In April, like I said, you're up. I mean, that's half of people's usual performance that they've received in the first 2 weeks of 1 month. Be okay with that. You have to be invested. Long tech is still the most crowded trade. This next one. Inflation, as we know, I will say that, but look, assume knowledge. Inflation is linked to the 10-year Treasury yield. 10-year Treasury yield will go up with inflation popping up. Interest rates need to cop up. The bonds need to be sold because they're preemptive. It's all sort of just one thing cycling after another. And that's it. This is the Fund Manager Survey. What percentage of the 10-year Treasury could be the level of reckoning for stocks? When does a 10% correction hit? Always be aware of this. 2% was the number. It's currently at low 1.6%. So it's still got a little way to go. But it was, it looked like it was well and truly on its way there for a second a while ago. But look, it's not. Well, it's going to get there. But there you go. There's also a point in the sand, a line in the pointy sand, a line point in the sand, whatever it is you want to say, where does it actually become physically you can just go then move from your safer equities positioning that's just paying you a nice healthy yield. When can you make that move back to bonds, which is much safer? That number comes up around 2.5%. So that's something to really be aware of as well. The people will just, your risk manager will say you have to move from that to that because that is less risk for the same return. If you've got two things with the same return, you don't know which one to pick. You've got to pick the less risky ones. That's one of the basics of portfolio management. So be aware of that kicking in as well. Back to it. Next slide, please. My inflation 10-year yield buster, the JJITYYB. I'm not an acronym guy. If you want an acronym guy, talk to Jim Cramer if you can catch him. The return of the inflation spectre. It's all over the papers. People are saying, what if inflation is a bit higher than it should be? High inflation raises interest rates. It destabilizes the exchange rates because then all of a sudden different central banks have got different rates of interest. Different currencies get bought and sold based on the carry trade, where the returns actually are. That's going to be stuff all over the place when that happens. Labour markets get unrested because people need higher wages to pay for these crazy mortgages that they all took out because of the raising asset prices. And free money, suddenly that money stops being free. Well, then you've got a bit of a problem on your hand. You've also got companies that have been trading on free money, trading on the expectation of free money. Suddenly that money stops being free as well. They start to get destabilized too. If you get a Goldilocks scenario where everything sort of just ticks up and everything's great, then like Jamie Dimon said 2 weeks ago, where he said we're in a Goldilocks environment, the market will teeter on upwards. Interest rates will sort of teeter on nicely upwards or not really get pushed up high by anyone specifically. Inflation will just teeter on nicely up, won't be out of the box, it'll be just nice and comfortable. And okay, if that is the case, then that's fantastic. However, if it does get stupid, like 6% year-on-year CPI stupid, as Tavi Costa on the right here is saying, You're going to get back to like 100 years ago, 1910s or the 1970s, two really high inflationary areas. The Dow Jones only returned 0.91% and 0.47% return, respectively. And considering inflation, which is that the cost, the value of your dollar gets eaten away, you're actually in negative returns. There's no value in really holding that cash in the market. If that's the case, then gold suddenly starts to look really attractive as well. Be aware of that. So this is the chart that he put up. Tavi Costa, very good guy to follow on Twitter. He's got some really good intelligent charts like this, but he's always bearish. So just take that with a grain of salt. Be aware of what's out there and be aware of what the worst case scenario is. That's usually something that he's talking about, or zero hedge. But stay bullish and be happy to be bullish. But just be aware of it. If anyone says, "Oh, why is the market coming off?" Oh, well, inflation has been 6% for some reason. Be aware of that. That's why it's coming off. So look, these are the periods in the market when it goes sideways. Right now, it's not looking sideways. It's looking like it's going up. So be a hold of that. He puts the question mark in the box at the top right side of that black and white chart. He just loves doing that. People love doing that. Oh, okay. And then your mind immediately says, okay, well, that's going to be the next thing. No, it's not. He's just put a box there. Relax. All right. Anyway. But businesses are warning that inflation is going to start to impact them. Those input costs really start to impact them. You've got more input costs. You've got more costs. You got to think that's either going to eat your margin, or you'd have to pass it on to the end consumer, the end customer of the business that you're selling stuff to. 3M, a lot of input costs. They're talking about rising freight and air costs. You've got Breville, etc., saying that wage costs are rising, which is great. An uptick in wage costs, I've got no problem with that. That should be a thing. People need more money. People need more money to buy Breville's espresso machines and Wursthof knife sets. That's what they need to do. What is it? Henry Ford, who said, I need to pay my workers and give them the weekend off. Otherwise, I won't have a chance to drive my car. Pay people more to do better stuff. There's no rule that says that you can't do that. So more people, more money in pockets, more workers, more happiness, more everything is great. And inflation doesn't really matter that way because people are getting paid more. Moving on. Now, costs are up everywhere. We know this. Okay, so packaging, that's expected. There's more input costs. Be aware of that. At the consumer, at the actual cash register, this economist Alberto Cavallo from the Harvard Business School has created this beautiful inflation gauge. It's actually based on credit card transactions as opposed to whatever basket a central bank or a reserve bank or whoever wants to judge things by. That's actually reflected what the Americans have been buying. It's higher. It's gone through 2%. So don't worry about any of this other 1% stuff. Like it's going higher, the 1% to the 1%. Thank you, Bernie Sanders. He's not here. But look, inflation is going up. Actually, at the till, it's going up. We need wages to go up to meet that. Otherwise, there's going to be some real trouble. And also, we need some of these supply restraints to come off. But I'll get to that in a second. Now, investing based on inflation. UBS. This is a lovely chart. I love a good chart. Sums it all up. These are the 10-year break-evens, which is just the 10-year with inflation factored in. So actually, it has the 10-year break-even at a rate which is sort of getting towards that 2.4% mark. So where does that rate get to in the past when it has started to impact various areas of the market? When it starts to get up towards that 2.4-ish area where it is now, emerging market stocks, really start to look very unattractive. So that's where the problems is going to hit. A little bit higher than that at 2.5%, the S&P 500. As I said before, 2.5% is where you move out of the S&P 500, a big chunk of your portfolio, and you move it into the bonds because you can. 2.5%, that's the number. When it gets to there, the real number, when it gets to there, the S&P 500 has got a real problem ahead of it. And then all of a sudden, I'm going to be in a situation because my big value trade, which I've had for the last quarter or so, suddenly starts to get underwater because at about 2.9%, the value suddenly starts to get hit. Be aware of that too. And up towards 3.5%, that's where European value starts to get hit. I like European value. Don't tell me I had many arguments about going into European value, but look, that's all by the by. I would have been really happy to go into that, but it's run its course and that's it. So right now it's just a buy and hold, a hold situation, and anything you're going to do is rotate it to gold. I'll get to that in a second. Next, shortages. There's shortages all over the place. At the same time that we had huge weather issues on our eastern seaboard, all through Queensland, New South Wales, Victoria, we had flooding setting us back a little while. We've also got timber shortages here in Australia. Any constructor or contractor I talk to, and I talk to a lot, all mention that there are some huge timber issues, lumber issues. They can't get lumber. They physically can't get it. Then you've got the semiconductor shortage as well. because of the lockdown. People were using lots of laptops, people using lots of computers, people using lots of semis, cars, EVs, more everything, semiconductors all over the place. Huawei was hoarding semis as well. You basically got one company, Taiwan Semiconductor, that do everything. They're under a lot of strain and they've got to stay where they are. So people are talking, and then you got the trade war stuff that was kicking into it as well, that was really starting to stick it over there. Down the bottom, thank you, global warming, global cooling, global whatever. Texas had a beautiful bout of lovely unseasonable snow, had them underneath that. And, well, obviously, if you put one of the biggest oil producing places in the world under a couple of feet of snow, then you're going to have a bit of problem. But it's also the downstream stuff as well. So imagine the supply chains of you've got someone making plastics, then takes it, has to go on golf balls, and then the golf balls over somewhere else, then they take golf balls over to they take timber over somewhere else, and that's a supply chain. The trucking companies needs the plastics to go and get the golf balls, because that's where the golf balls are made, where they're delivering the plastics. They take the golf balls to somewhere else with the timber. They take the timber somewhere else, and that's how a supply chain is. You get one of these things sort of getting stuck in the works, like plastic polymers. Going to go for it. Polyethylene, polypropylene, and polyvinyl chloride. Thank you, 10 out of 10, James. Nailed it. You suddenly get a sticking point of them that can't be made. The trucking company doesn't have a reason to go to the next place. Then those golf balls, for example, I just thought of that because I'm looking at golf balls here on my desk, but those golf balls don't have any reason, or don't have any way of getting to the next place. The next place then doesn't get their timber, and that's these little price impacts that we have sort of hitting us in the head. Kind of scary, but look, that's what we're at. So there's still stuff all over the place with regards to this. It means that the price of this stuff just goes up. There's a really good expression that was made when oil was started to be in shortage after a hurricane, I think, in the States. And they were just like, no price gouging, no price gouging. And it was Dennis Gartman, actually. I'm not a huge fan of his, but what are you going to do? And he did mention this beautiful phrase, no price gouging. At a time like this, you want to let people charge whatever they can do, because here's the thing. People, after Hurricane Katrina or whatever it was, they couldn't get oil at $40 a barrel. But there'd be plenty of oil at $100 a barrel, because it suddenly becomes worth someone's while to go over there and do it. That's where that input cost needs to be able to be pushed up to allow a company to actually go and, okay, it's worth our while. That trucking company doesn't have a reason to go and get those golf balls. So then the golf ball people have got to say, okay, we'll pay you extra to come over here and take our golf balls. Otherwise, they physically won't go away, and then we'll start to see that input cost. I hope that I've sort of summarised that metaphor well. I did this presentation a while ago. I didn't record, but I went into this whole golf ball thing. It was wonderful. Anyway, look, imagine it was a great metaphor. Just leave me alone. And this one on the top right of the screen is just a put your head in your hands sort of situation. I just can't. I can't get over just how amazing this is, that you can talk all you want to have about all the vaccines and all the science and all the technology in the world. If you can't make those little glass vials to actually put the vaccine in and get it around the world, it's all a waste of time. They're running out of glass. They're running out of those glass vials. The company that was doing the glass vial isn't. It also then, here's the other thing that kicks down. Everyone's so focused on the vaccine. Everyone's so focused on getting the vaccine out that they're taking those vials, and this is actually under the big Defence Act thing that the Yanks have, where they can just transfer companies what they're making to be able to help with the war effort, and the vaccine was seen as being part of the war effort. It blows me away that now that the vial, so if you need something for your eye treatment that comes in a vial, you can't get it because all the vials are being used for the vaccine. It's I'm speechless by these things, but look, that's it. Moving in now and just wrapping it up beautifully. Gold, I'm buying gold. I've been buying gold for the last couple of weeks. I'll get my beautiful face off the page here. But gold is structurally looking amazingly now. There's 4 things you do when you're investing, be aware. Macro, sentiment, fundamental, technical. When you invest, always get those 4 things in line. You should be okay. Gold, don't worry about the fundamental, but the technical is looking amazing. Look at some charts on gold. It is actually starting to look like it's breaking back up out of being in a real slump. The fundamental behind it is pretty much that inflation is here and that everything else is way overboard, and that where are you going to put your money because it can't be in cash, especially if it's a sell in May going away sort of situation. So that's where that is. And then sentiment is ticking up as well. We're starting to see inflows into gold. Sentiment is ticking up as shown on the chart on the left. The little green line is the sentiment index, and that's started to tick up. I'm really happy with that too. So it's an uppish direction, and that's broken out as well. Really easy technicals to follow. Be aware, be aware. On the right, bit of fun there. In a pretty tragic situation on that Archegos capital situation where Bill Huang has managed to blow up a few $1 billion worth of people's money. That's something. But that's also this is how banks work. He was leveraged multiple times over, huge risk. They needed to start liquidating some of his positions, and instead of working together, Goldman Sachs just dumped it onto the market. Phenomenal. Left Morgan Stanley almost holding the bag. They got rid of it. Nomura, they then got rid of it also. And Credit Suisse were just sitting out there waiting for everything to get better, and they're looking at maybe a 10. Don't worry about that headline there. I put that in a couple of weeks ago when I was doing this presentation. It's more like $10 billion now. It looks like Credit Suisse has lost. That's a lot of money for a bank. It's another European bank who's been blown up by nonsense. Now, hang on. Personal advice tells you the VFS, managed discretionary accounts, doesn't have to be. I do a lot of stuff that's on advised as well. But the managed discretionary account is the way to go for the overnight trading. If you do prefer that sort of thing, so that way you don't have to be up getting advice. But that's how the MDAs run. Most of what I do is overseas. We've got the strongest portfolio management system, I believe, and the strongest trading system on the planet. Interactive Brokers works really well. Nice low cost, so you don't get eaten by a lot of execution fees, and the ideas keep on coming, which is great. So true wealth management. Now I've got some. I've got. Hello, thanks for joining us. I've got some other trades. Commodities, I'm still in commodities. So this is my inflation buster. So like I said, I'm still in commodities, which is great. That's actually started to tweak back up again. Started to break back up. Oil is back up. Copper is about to get another leg. It's going to be fantastic. Watch that happen. Still happy to own commodities over in London. Value, still happy to own value. Inflation, I still own that INFL ETF, which is really good. And food, still really happy with food as well too. Now, some other little bits and pieces that I've got in portfolios. Lithium, we've got aerospace and defence, we've got, that's all part of the global rotation strategy. We should have semiconductors, just got an inch away from our automatic entry into that, and we just missed it. So rules are rules, we didn't do it, which is good. It's good that we followed the rules on that one. And like I said, I added gold unhedged, so that's GOLD, which is locally traded. And that I've put together, I'm pretty happy with that one as well. And that I did with new money. That wasn't shifting out of anything. I love this. So I just took profits on value. Like I said, I closed out of small caps already, and I'd already reallocated that to around different places. Small caps just looked like the value was stretched, and that was done. And they're going to be as inflation starts to pop up, some of those ones are starting to get a bit hit. Technically, it looked like a bad buy as well, and it was. So the small cap index has actually come off quite substantially since I got out. So I timed that pretty well. But I just shaved profits off food, shaved profits off inflation, shaved profits off value. And I use those small profits, 2% each, 1.5% each, to just reallocate into gold, new money into gold, nice and safe. Should be okay. I'm pretty happy with the way that's worked out. So I'm happy with the way that it started on those ones as well. ACDC, not mentioned there, which is another ETF that I went into a couple of weeks ago. Really happy with that one as well. It's a battery ETF, really well run. Just happy with that one as well. I think the batteries with the electric vehicle. I've talked about EV. A lot of times with the EV revolution, batteries are the key source of everything on that one. It's not necessarily, we know the metals are that make the EV car. We know that copper is needed to do all this stuff that's in there. We know that rare earths are needed, but the battery tech is the real crux of the matter in this. So invest accordingly on those things as well. So look, that's me. If you have any questions, please let me know. I've just done some really, really good work with live wire markets. I realise just how stuffed up I am. I'm sorry about that. It's cold, but that's it. But I've done some really good work with live wire markets recently on ETFs. Really big push in the ETF space, and a lot of call for us to do more things on ETFs. I do everything I can in ETFs, so that's why I'm the guy that they talk to on this one. I'm answering a whole lot of questions on ETFs, answering a whole lot of questions on what goes up, what goes down, and why, what I think is going to. This is some of the best stuff. I reckon, in my view, this is some of the best stuff that you can get on simple, easy, don't overcomplicate it ETF investing. There's some really good things that we have here, and I'm glad that I get to communicate them to you. If you have any questions, please let me know. That is the end of this presentation. Thank you very much. Performance is looking great. I'm very happy with it. portfolios are strong and stable. Now it's not time to rest on the laurels. It's time to be picky. It's time to be choosy, and it might be time to hit the sell button on a few things as well. So keep locking in profits and being guided by that. I don't like to invest based on rhyme. The selling may go away thing, go away. That's very interesting. Morgan Stanley also said it best, which is, why would we invest based on where the sun is in the sky? It makes no sense at all. Where the rotation of the Earth on its axis makes no sense. But because it's been happening for so long, it is now just the way that things have to happen. So if it works, it works. So I'll be happy to take a bit of profit in the next couple of weeks. So that's probably what I'm going to be doing. I'll let you know, and if you have any questions, let me know as well. Thanks very much, and stay safe out there.